The first section of a balance sheet lists all the assets of your practice. In their simplest form, assets can be thought of as either cash, something that can be turned into cash, such as accounts receivable or inventory, or something that helps you produce cash, such as your furniture and equipment. Take a look at the amount of cash on your balance sheet. One rule of thumb is that you would like to have 1.5% of your gross revenues in your bank account at all times as operating capital. Note that this percentage is just a place to start. Some practices will need more, and some will need less. Practices with less cash than this may have trouble meeting payroll or paying their bills on a timely basis, and practices with more cash than this should consider alternate uses, such as moving the cash to a higher interest-yielding account, reinvesting in the practice, or paying bonuses out to owners. Another line item you will want to review closely is accounts receivable. This represents the amounts you have let clients charge for services you've performed. Ask yourself if your accounts receivable is increasing or decreasing, and why. It is also important to look at a detailed listing of the accounts that owe you money. This usually comes from your practice management computer system and lists each person who owes you money, how much they owe you, and an aging of the amounts owed. The aging breaks down the amounts owed into current amounts, less than 30 days, 31 to 60 days, 61 to 90 days, and more than 90 days. Reviewing the aging is very important. A high dollar amount of accounts receivable that is all current is much less worrisome than that which is greater than 90 days old. The older accounts get, the much less likely it is that people will pay them. The next section on the balance sheet contains liabilities. Liabilities are generally amounts that a practice owes other people. Common liabilities include accounts payable to vendors, amounts owed for the purchase of the practice, sales tax payable, and payroll taxes payable. One way to evaluate your assets and liabilities together is by calculating the current ratio. This ratio is a test for solvency and is calculated by dividing current assets by current liabilities. Current assets include cash and those assets that will be converted to cash within 1 year. The biggest ones are usually inventory and accounts receivable. Current liabilities are those that are expected to be paid within 1 year. You will see separate sections on the balance sheet for current assets and liabilities versus long-term assets and liabilities. Let's assume your current assets equal $400,000 and your current liabilities equal $200,000. You would have a current ratio of 2 to 1, which means you have twice as much cash and liquid assets than you have obligations which need to be paid. If your current assets equal $100,000 and your liabilities equal $200,000, then you have a current ratio of 0.5, which means you don't have enough cash and liquid assets to meet the obligations coming due within the next year. In a small animal practice, you'd like to have a current ratio of 3 to 1, in a mixed practice 4 to 1, and in an equine practice 5 to 1. You also want to pay attention to whether these ratios are getting better or worse over time. These are rules of thumb only and will be influenced by your practice's level of accounts receivable and bill-paying philosophy. In addition to analyzing your financial statements for information about ways you can improve your practice, you can also review the various related management statistics commonly used in veterinary practices. Some of these include clinic and doctor production, average transaction charge for the clinic in total and per doctor, number of transactions per clinic and per doctor, and number of new clients.